and we'll probably just have a bit of a chit chat anyway for the first little bit. And I'll just double check if it's actually starting now. Yes, I think it's about to kick in. We should have some people watching. Awesome. Good evening, everyone. We've already got 30 watching. That's a good start, Martin, for a topic like this. I wouldn't have thought that when we started the YouTube channel and we were talking that people would be so interested in finance. It can be a bit dry, but then we have a banking royal commission all of a sudden.
And the magic happens.
Yeah. So, guys, we're going to have a bit of a chat, and feel free to ask questions and jump in and get that conversation going anytime. So everyone's saying hello. How was your day, Martin?
My day was busy today. Funnily enough, there were a few people talking about something called the Royal Commission.
You've become a bit of a celebrity.
I don't know about that. I think the media people were looking for somebody with alternative views, and I have plenty of alternative views, so it was tended to be probably the reason, I suspect.
Yeah, I wonder at what point do the little channels like ours start to really compete with some of the mainstream news stuff in terms of people that are just getting fed up with what they're being told and actually wanting a different point of view. So hopefully people keep coming our way.
Well, it's clear to me from the DFA channel that a lot of people just have given up on the mainstream media because they don't think they're getting the full story, the full weight of the arguments.
Yeah.
So I think the things that we can do with our smaller channels is to really go into the details, but also give it a better, more objective perspective. And I think that's probably what people like.
Yeah. And for those people that are just tuning in that are new, Martin runs Digital Finance Analytics. So make sure you go over and subscribe to their channel for all the latest housing data. And what's it grown to now, Martin?
Well, on the Walk the World, so Walk the World is my DFA channel because Walk the World is my production company, and we've got more than 14,000 subscribers on that, and they've got about another 10,000 subscribers on the DFA blog, which is at digitalfinanceanalytics.com. So between the two of them, and then I've got various other social media channels as well. So what I tend to find is that people tend to use the YouTube channel, but also use the DFA blogs. And that's where the DFA blog is where a lot of the analysis is posted.
Yeah, and that's where I love our collaboration, which I think we'll do towards the end of next week, because there's been so much data come out just even today, hasn't there?
Yeah, plenty of stuff around. And I'm just running on the mortgage stress data and the household financial confidence data. So that'll be out later this week, early next week. So we'll have plenty to talk. Retail sales were down today by 0.4% in December. So
yeah,
more
I can't. I'm working on that documentary for those that don't know, and I can't keep up with the data quick enough. I get a slide ready, and then there's more data, and it's worse a lot of the time. So it's worth updating it. But
welcome to my world.
Exactly. So thanks, guys. We'll jump into it and get started. So, Martin, the first, I guess, question for people that aren't familiar with all this is the Twin Peaks model. We keep hearing this term, and explain the role of ASIC and APRA for people at home.
Sure, yeah. So there is something that people need to understand is we have a really quite complex regulatory structure for financial sector in Australia. And of course, we've got the Reserve Bank who sits over the top, but we've got APRA, who is the prudential authority and looking basically at the authorised depository institutions or the banks, and they look at things like capital ratios and those sorts of things. And then you've got ASIC, which has responsibility for sort of corporate behaviour and compliance. And ASIC, of course, has responsibilities for both the consumer side and also the company side, and a bunch of other stuff too. And so the idea is that APRA, from a banking perspective, looks at the prudential framework. So in other words, what capital they should hold and what risks they should manage. ASIC looks at compliance and keeping the law, basically. ASIC published the responsible lending laws more than a decade ago, which of course was subject to in the Royal Commission. And so these two organisations work together, Twin Peaks, but of course there's massive confusion between the two of them as to who does what, and the Royal Commission show that in fact both were sitting on their hands waiting for the other one to do things, and both tended not to go to court to try and deal with bad behaviour, but sort of work with the corporates. And so they were really seen as to be on the same side of the fence. So you had two separate regulators, but both of those were on the same side of the fence as the corporates, which meant that effectively they were ineffective. And that's one of the key things that came out. But that's what Twin Peaks means.
Yeah. And so for those people at home, we have regulators, and then all of a sudden it comes out that there's all this bad behavior coming to fruition, and all of a sudden there's this suggestion to regulate the regulators was one of their recommendations. And is that the case in any other countries, or they're talking about avoiding this at the time being?
Yeah. So there are various attempts around the world to deal with regulation. In some cases, there's one single entity. For example, there's more consolidation in New Zealand, or if you look in the UK. Elsewhere, you've got these two faces, and then you've got some ability to try and bridge over the top. So the reason, and by the way, David Murray 5 years ago, when he ran his financial systems inquiry, recommended an entity over the top to test that they were actually doing the right thing, and that was rejected by the government at the time. So it's not new to suggest another sort of peak regulator. But my concern is I'm not sure how that small group of 3 part-time people are actually going to get to the point of being able to decide whether they're doing the right thing or not, and also trying to work out who should do what between the two regulators, because at the moment it's completely unclear. And there's massive gaps between the two, or in some cases there's overlap. So that's the reason why they're suggesting that there should be some sort of super regulator. But it's not a very well used model, and I think it's going to be fraught with confusion. So I wasn't impressed with that recommendation. I felt that the Royal Commission basically hooked that particular question.
Thanks, guys. There's some good comments coming in. We'll read a few of these as well at the end. A lot of people talking about Labor and the election. We'll get to that as well. But for people at home that aren't familiar with how do mortgages, that's been the real focus for a lot of the commission, but there's all sorts of loans and insurance and financial advice that this has delved into. But talk about the vertical alignment or the integration now. We have the big four banks, but these other brokers that it is their living, this is their job, and to talk about how that process plays out in the real world.
Sure. So the first thing to say is if you think about the mortgage industry, about 60% of loans are originated by what's called mortgage brokers. So these are people who are SMEs effectively. They run their own business. Yeah. They may be part of a larger aggregation group, but essentially they're trying to advise borrowers or potential borrowers of what loans they should go for. And then what they do is effectively help that process and then point them towards a particular lender. And the lender at the moment pays a commission back to the mortgage broker. So 60% of loans at the moment go through that channel. Now, here's the problem, right? If you think about the process of searching, finding a product, going down and identifying which product to go for, and then making the application, and then effectively buying the product and then having it funded and delivered, that end-to-end process is a great example of the integration we're talking about. The problem is if you're actually helping somebody to decide what product to buy, and you're also representing an organization who has products to sell, then effectively you are not independent. And if you are receiving commissions from the bank based on the sale that you recommend, you're not independent. So this whole point here was that effectively the Royal Commission said, this is conflicted remuneration. In other words, you're being paid, but you're not being paid independently, despite the fact that consumers think you are. So the fundamental question about mortgage brokers is, are they independent and who do they work for? So what's happened with the Royal Commission on this one is the suggestion that down the track, firstly, trailing commissions, which is effectively paid year after year after year, not just year one, but subsequent years, will disappear. So for new loans, there will be no trailing commission initially. And the second recommendation is that ultimately, rather than a commission flow coming from the lender, which is based on the size of the loan, there'll be a fixed fee of some sort, or a fee of some sort, but paid by the borrower. And that is a complete earthquake when it comes to the mortgage broking industry, because effectively mortgage brokers have been used to receiving very large commissions from, let's say, $6,000 or $7,000 over the first couple of years, right? So these are quite big numbers. And the typical fee that you'd probably need to be able to deal with the sort of effort that's involved in advice will be a couple of $1,000s. So suddenly a mortgage broker is seeing his income or her income dropping by 2/3. And then secondly, the other point there is that a lot of mortgage brokers point business towards smaller second-tier lenders or foreign banks or international players who don't have a branch network.
Yeah.
And if the mortgage brokers effectively start disappearing, then suddenly the big four effectively will get back their market share. They're sort of sitting at 75 to 80% of the market in terms of loans at the moment. But the concern is that suddenly you'll find that effectively those big four organisations control the game again, and mortgage brokers who have effectively helped to create more competition disappear. So this is a really big deal. I agree that commissions need to be changed and need to be more disclosed, but I'm not sure that turning it into a straightforward fee paid by end users is necessarily the right answer. But then the government said they won't necessarily go there. They'll review it in 3 years' time. So even that is not certain.
And if you are a broker, guys, make sure you let us know your thoughts in the comments below about this as well. I'd love to hear from you guys. But 60% is a very high number for that loan origination. And one of the things I guess we've both started channels for is financial literacy. A lot of people weren't even aware they're paying interest-only loans, for example. So you'd have to think that a lot of people aren't aware that they're paying, these fees further up the food chain. If you said to them, Alex, that's $500 up front, or, this is going to be an ongoing fee, all these sort of things, they'd be pretty oblivious to it.
Yeah, so the original commission was paid by the bank to the broker. It was never really fully disclosed to the end borrower. The argument originally was, well, it's irrelevant to the end borrower because then they never see it. But of course, that cost still has to be paid by somebody in the system. So basically, it would be a cost the bank recovers in some way. But the whole point is here we need to get more transparency. So people need to understand what brokers are being paid and why they're being paid and what basis they're being paid. Yeah. Most from my surveys, most people assume that mortgage brokers are giving objective, independent advice based on the whole of market. They're not. They will be giving advice based on a subset of the market, based on who they have relationships with, and influenced perhaps by the commissions and even soft commissions that they might be getting. So currently the model is broken. And we saw in the Royal Commission that in some cases, people will put into loans they should never have got into, interest-only loans, too bigger loans, all those sorts of things. So we know that there have been cases of poor behaviour and even fraudulent activity. So we have to sort of get that cleaned up. But more importantly, we want end users who choose to use brokers to understand on the basis on which they're using them, which currently they're down to the moment.
So just to give people a real-world example there, if I'm coming to you and getting a loan and you're working out if I can afford it, this is one of the things that we have been talking about a lot in the housing bubble or situation, whatever you want to call it. But if I know that Martin is getting a huge kickback, if he gets this documentation over the line and then I'm out of his hair, not to worry about, that's what has caused this greed or whatever you want to call it in a lot of cases, isn't it?
Well, that's right. So basically, everybody wanted to feed out of the trough, right? And there were a lot of hangers-on and a lot of people providing referrals as well as mortgage brokers. And it was all about the bigger the loan, the bigger the commission. So there was an incentive to make a big loan or even a bigger loan. And then, of course, based on who would pay the highest commission, you might take that business to a particular bank rather than what might be best for the consumer. So it was completely muddy. And as I say, the difference between what consumers thought they were getting, which was objective, independent advice, and what they were actually getting, which was, who knows whether they got the best deal or the right deal or not, is the fundamental problem. So change needs to come through, and just simply saying, keep the status quo is not going to work. We need to change it. But this is quite complex. And so the question, of course, which is what the Commissioner said, was, well, we need to be careful about the way that the competitive landscape is architected as we change some of these things. And that's why he's given a long run time of 2 to 3 to 4 years to sort this out. But, the writing is on the wall for mortgage brokers at the moment, I think.
And we've got a question from J-Bag saying, please ask Martin about the competition between the big four banks that is generated for the brokers. And I might add on to that because I do have friends that are brokers, and to play devil's advocate, there's some people that work in these community-focused branches where we don't have big four, and a lot of people might be doing honest work, and that's, I guess, the other extreme, isn't it? That we're going to take that away and the competition might be decreased. Yeah.
So you're right. The real problem is, and I know quite a few mortgage brokers, I've done a lot of work with mortgage brokers, there are some really, really great guys there who do the right thing on the right basis and make the right recommendations and are very transparent about the fees they charge or the commissions they receive. And they do great work and consumers get great outcomes. So that's at one end of the spectrum. And that's good. And it's good for the industry, and it's good for competition, and it's good for consumers. And the other end, we know that there are some mortgage brokers who are doing the wrong thing, who are effectively, just out to maximize their commission and will do anything to get the deal, will change entries on paper applications to inflate incomes to be able to get through the underwriting standard, all that sort of stuff. So there's this massive continuum, right? Now, the problem is what we don't want to do is end up with a set of rules that basically stops all the good guys from continuing to be good guys just to sort of deal with the few percent that actually are way off key, right? And that was because the aggregators that they're part of and the banks that they work with are not actually understanding enough about what they're doing to be able to put the skills, and experience and stuff into the right place to stop these sorts of things happening. So effectively, the answer from the Royal Commission, which is to change commissions and bring in what's called a best interest duty. That's the other thing we should highlight. So basically, at the moment, brokers do not have a best interest duty. So in other words, they're not required to give you the best loan. It's just not unsuitable, right? Now, what the Royal Commission wants to do is to move that to a best interests duty, which basically puts them on the same playing field then as financial planners. And what I think down the track is you'll end up with a converged set of rules, whether it's financial planning or whether it's mortgage broking. But no, the problem is that, this is a sledgehammer to crack a nut, in my view. And I think that there are a lot of really good mortgage brokers who suddenly will find that their business model is completely broken.
Yeah, and the next thing I want to ask you is about not generalizing, but are these people, once they get you on their broker books with a mortgage, they have targets to then get life insurance, credit cards, super and other financial advice? Is that a general rule, or is it little segments and they're all trying to get pieces individually? Or
yeah, so what's interesting is that many mortgage brokers will predominantly just focus on writing more home loan business, although these days they're looking for the cross-sell perhaps to credit cards and insurance. But it's the banks themselves, once they've got that loan, that mortgage, the bank will then fire up the cross-selling activity directly to the consumer, right? So one of the interesting questions is, well, who owns the consumer? Is it the mortgage broker who brought the relationship, or is it the bank who actually now has the loan? And of course, banks are all about cross-selling and upselling. So they try to sell insurance and they try to sell other products and services. And again, the Royal Commission highlighted that those products were being sold on a false basis often, that people were being persuaded to take products they never should have taken. And effectively, it was all about maximizing what's called the share of wallet of that particular consumer. In other words, trying to get more and more products to that consumer. And the thing that the Royal Commission has said is banks have to understand that they have a responsibility to do the right thing by the customer. And the right thing by the customer isn't necessarily just flogging products all the time and trying to meet targets to be able to sell ever more products. Yeah. And yet that is the way that the industry has gone over the last 20 to 25 years. Yeah. Most people in banks have targets. Most targets relate to variable remuneration. And even frankly, until quite recently, tellers were given sales targets. So when you went in to pay your money over the counter, they could try and sell you a deposit account or something, right? It really was nonsense, right? So what we've got to try and to find the right path between helping people to understand that there may be other products and services that people will benefit from, but not having it forced down their necks, and not essentially just being given stuff for the sake of being given more stuff just to increase profits. Yeah, that's the conundrum.
And Caroline is saying, as we said before, she had a great broker, saved her thousands and whatnot. So certainly good instances out there. Another question now saying, was this a bit soft, Martin? And I was going to talk about this at the end, but let's talk about it now. Has this been too soft, particularly on the Big Four, where now all these brokers are going to get their power maybe taken away from them or restricted, and people end up going back to the Big Four banks, and that creates even less competition, guys?
Yeah. So let's talk at two levels. Firstly, in the home loan sector, absolutely. There's no doubt in my mind that the Big Four banks are the winners of this. The mortgage broking sector and all the second-tier banks are the losers of this. So if we're not careful, we're going to effectively see competition eroded. That means that the banks potentially could charge more for those mortgages and just dominate the market as they did 10, 20 years ago. So that's a big deal. More broadly, I think that's also true. So effectively, a lot of the issues which were brought out in the Royal Commission, we may touch on this a bit later, things like culture and looking at it from a customer perspective, it's all been thrown back to the boards and to the senior executives to basically sort it out, right? Now, the question to my mind is, to what extent are these large organizations capable of and willing and able to effectively change the culture that's been there for the last 20 years and look at it from a customer perspective? And I have my doubts about that. So that's one of the reasons why the stock prices have gone up dramatically today, because essentially what this has done is to effectively buttress those big four banks compared with perhaps what people thought before the Royal Commission came out, and frankly, what was expected based on all the evidence that was actually presented over those hearing days. And so, yeah, we've got a situation now where I think the pendulum has swung back to the big four. And frankly, I was very disappointed, because I think we've missed a big opportunity here to really get our financial sector sorted out for the next generation. And I think, frankly, it's been squibbed.
That's pretty frustrating, as a lot of our followers aren't the biggest fans of banks, and to hear that they've basically got away with it, pretty frustrating, guys. So thanks to everyone that's tuning in. Hit that like button and share these videos around. But another question now, Martin. Farmers having access to the debt mediation scheme, and I believe there were some farmers in disasters, or some instance, one of the worst examples.
Yeah, so, and in fact, a lot of farmers and a lot of other businesses too, but farmers particularly, were in significant issues because, of course, they have a very cyclical business, and quite often if they have droughts and things, they have huge issues with regard to cash flow. And unfortunately, the banks were in the situation where they would just come down really heavy on those farmers, and essentially, there's no way out. Now, what they've tried to do is to provide a better sort of system to help in those situations. It's not perfect by any means, but I think potentially it has the prospect of providing at least some relief in some circumstances. But it's tricky, right? Because effectively a small business owner or a farmer is a commercial operator and a commercial entity. So you can't necessarily just treat them like, a retail customer, right? They have to take some responsibility for the business model that they've got and the business decisions that they've taken. So it is quite tricky to get the balance right. But I do think that in the agricultural sector in particular has been very hard done by the banks. There was very little evidence actually presented. There wasn't time for it. There should have been more time, in my view. And many farmers were really pissed off by that. But the fact of the matter is, there are some things here that could benefit, perhaps, if it's allowed to run through as people hope it might.
Yeah. The Big Four also the Big Four in New Zealand. What's the likelihood that similar crop behaviour is happening over there? Well, I mean, guys, we've seen the GFC, and let's talk about it. This is systemic behaviour, isn't it, Martin? And people are human beings. If you dangle a carrot and say, Alex, you're going to get all these big bonuses as long as you get over the line, people want to put food on the table, and very few people are ethical if they don't see the implications right in front of them, aren't they?
Well, let me be controversial. It's capitalism, right? Capitalism is about maximising your return at all costs. It's about increasing returns. And frankly, people will do quite a lot of things to make that happen. Now, we have to temper that with ethics, and we have to temper it with a focus on customers. The problem is that the Royal Commission showed that certainly greed had driven very bad behaviour into our banks here. And interestingly, the review that was done 5 years ago in the UK came out with very similar consequences and implications. And my suspicion is that you would find precisely the same stuff going on in New Zealand. In fact, there was a recent review done by the Reserve Bank in New Zealand in the insurance sector, and they came out with pretty much the same findings, right? So, yeah, you've got to assume that the same behaviour is pretty much in any country where there's a banking system that's driven by maximising return to shareholders. And what we've got to try and do is balance that, because obviously shareholders legitimately need a return, but it shouldn't be at the cost of consumers, and it shouldn't be just flogging more stuff that consumers don't want. There has to be the right balance between the two. And frankly, I think we've lost our way here, and I think probably the same is true in New Zealand too.
Do you have any thoughts, Martin, about the older days and nationalising banks and breaking up the Big Four banks and all that sort of thing? Is that too idealistic these days, even just in Australia?
Well, look, I mean, if you go back a generation or two, and my dad was a bank manager, right? And he was a bank manager in a local community and stood alongside the vicar and the doctor. So he was seen as a professional, as somebody who was there to help the community and was frankly a listening ear, right? We've gone from that to a model where effectively it's flogging products, A lot of decisions are made centrally. There's no real community engagement. And as a result of that, we've seen all of this stuff come through. Now, the question is, can we swing that back to the point of reaffirming that customers are really important and trying to get the culture fixed? Well, maybe we can fix the culture, but it's going to be a hell of a long time to do that. Or do we actually look to an alternative banking model? And one of those is potentially to create a national bank, which essentially is there not to drive a profit outcome, but to drive the availability of credit for particularly businesses who find it very hard to get business credit, and maybe other things too. I think there's a legitimate role potentially for a national bank, and it's one of the things that I've been thinking about in terms of how do we change the way that banking works, because frankly the current model is still exploitative, and everything coming out of the back of the Royal Commission, we're not going to change that. So I think there's certainly worth thinking about a national bank. For the interests of the community, for the interests of the country, not necessarily charging a return. So if you think about a commercial entity, they're going to be making a 12% return on average, right? So they have to charge 12% more inside their business to basically support those profits. So if you basically said to a national bank, you don't have to make that additional return to shareholders, clearly you can actually function at a much more economic level, and that means that banking products could be cheaper. So that will be good for everybody. They will be more willing to lend, particularly to commercial entities that we need to borrow to be able to help growth. So I think there's potentially an opportunity.
And we won't talk about blockchain and decentralizing money and peer-to-peer lending, but again, I think that's something that's going to play into it in the future as well.
Oh, well, I think just, a sidebar. Absolutely. So my view is there is going to be a disruptive force coming through into financial services. And my own view is down the track at some point, it will be those those disintegrated, those disaggregated entities like those blockchain entities that will probably play into this and will shake the ground. The question is how soon. But yeah, the status quo is definitely not there forever. I'd agree with that.
Yeah. Final sort of wrapping it all together, Martin. There was 24 recommended criminal charges and 76 recommendations. Is this going to be a case of no bankers go to jail the same as the GFC?
I think it's quite likely that no bankers will go to jail. So what's happening is those 20 plus entities, including NAB, who was called out specifically, those cases will be passed back to the regulators, the very people who were actually accused of not doing what they should have been doing earlier on, right? And they will consider whether they take legal cases, because there is criminal behaviour potentially there. If they do, then they will go to court. That could be 3 to 5 years, right? So it's a long, slow grind, and there's no guarantee at the end of it that they will be successful in those prosecutions. So there's no certainty about people going to jail anytime soon. I mean, the entities, of course, are a bit shamed because they're there in public, and it's interesting tonight. Thorburn and the chair of NAB basically came out and said, "No, we don't agree with that. We think we're doing a perfectly good job of change, etc." So they're going to defend it rigorously. So there's no guarantee that anybody's going to jail. And with regard to the 76 recommendations, right, both sides of politics have said they're going to do something with them. Labor's pretty much said they will implement them all. The other politics have said they will act on them all, but that doesn't necessarily mean they'll implement them all. And we already know that in some cases they're sort of saying, well, we'll have another look at it in 2 or 3 years' time, and then we'll make. So I think it's too soon to see how this all plays out. But frankly, the problem I've got is this has become a political thing now, where effectively first people are just saying, consumers, it's all about trust, and there's a lot of words there, but very little action. And second, we've got an election, of course, in 3 or 4 months' time, and so all of this is going to get lost now in translation while the election is fought. And so my view is we're not going to see a amount of change for at least 6 months, and perhaps even longer.
There is a few questions coming in about the economy and the election, and who do you think is worse, Martin? Who voted against this more often versus who's to blame now? Or, is this going to favour Labor? Or what do you think?
Oh, gosh. Well, look, firstly, on the politics of it, we know that the incumbent government resisted very strongly the whole idea of a Royal Commission. They were bounced into it because of their backbench. They actually never supported it. And in fact, they blamed Labor for creating a lot of issues because Labor kept asking for the Royal Commission. So the Conservative side of politics basically didn't want it. They were bounced into it. They shape the terms of reference very narrowly, deliberately, and that's one of the reasons why we don't have commentary about the Reserve Bank and about some of those broader issues that I think we should have looked at. I think Labor has a clearer track record in terms of advocating a Royal Commission, but frankly, their ability to implement, if you look at the last time they were in power, is abysmal. And so even if they got him back into power, there's no guarantee that they would actually be able to take this forward. And if you go back to FOFA, which was the earlier review that was done in the financial planning sector, it took years and years and years to get those rules and regulations in. They were morphed all over the place and ended up in a rather different place to what was originally intended. So there's no good track record of either side of politics actually dealing with reform in the financial services sector. And of course, there's two things to say. One is both sides of politics receive a lot of money from the banks, a way of donations, and that's of course legitimate and it's declared and legal, but just bear it. And the second is the financial sector is so strong in terms of its ability to lobby and its ability to be able to assert itself that there is a tussle going on all the time between effectively, the government and politics and the big banks. And actually, frankly, quite often it's the power and money of the big banking sectors that wins out. And I suspect that we could see the same.
Yeah, and I don't want to put my conspiracy hat on too much, but you'd have to think with the housing sector the way it is at the moment and the election coming up, and if there was a really scathing report and lots of charges that the bank shares would go down, that hurts people's super. Consumer confidence is the big one, and a wise man that taught me a lot about trading once said that sentiment drives all markets. And if sentiment continues to get worse in Australia, it could be that self-feeding loop of a nasty recession right when we don't need it. And do you think that's why they've had a bit of a light-handed touch?
Well, I don't think it's directly to do with the risk of recession. Look, the forward-leading indicators aren't looking very, very flash at the moment, as we've discussed, and we'll discuss again probably in a week or so, right? But the fact of the matter is that the main concerns seem to be that they didn't want credit to become ever tighter. And we've seen a tightening of credit availability over the last year to 18 months. Lending standards have been a lot tighter. There were concerns that effectively the Royal Commission would push that even further. Now, they haven't done that. What they've basically said is there has been a tightening of standards, and that's right and appropriate, and that should continue. But we're not going to see an even tighter credit environment. So I suspect that the real concern was around that, because if you think about it, credit is the lifeblood of the economy, and if you tighten credit too far, it will actually continue to tank. But my concern is that a lot of those downside issues are already baked in. Home prices are already falling. The retail sector is looking pretty sick. Household confidence is falling. Income is flat. And there are already a lot of leading indicators to suggest we've got some downside risks in the economy. And so the question will be over the next 12 to 18 months, to what extent will that be able to be reversed? Do they cut interest rates? Do they actually do some quantitative easing, or in other words, put money into the system, or do other things to try and lift the economy back up? Or will we actually find that it's going to be a quick rebound and suddenly house prices are going to start going up and everybody's going to say everything's fine again? I'm very skeptical that we're going to see a significant reverse and suddenly prices are going to go up. My own view is prices will continue to slide because credit won't be as available. And a lot of those risks are already baked in. So I think the next 12 to 18 months are going to be pretty chaotic just locally. And then if you overlay the international issues with, the Trump bump, as it's called now, the Trump slump, issues with Brexit, slowing in China, I can make you a whole range of arguments as to why we're going to see more downside risks globally as well. That could hit us as well. So I think the fact is that globally growth is slowing. Growth is slowing here in Australia. It's going to be a bumpy ride.
And for people at home, the term liquidity is something that might be new if you're just getting into investing and trading. But again, it's one of those number one things that drives house prices. When people are lending out lots of money, that's what put up house prices. And there's plenty of money. Rich people, investors will buy more houses. But the taps have been turned off to some extent, as you say. And I'm working on this documentary and going over all the data with you each week and whatnot, and I just can't see a situation where there's going to be as much money or as much investing without these Chinese investors, without the easy money, without them turning a blind eye to people that can't afford it with their wages. There's so many things that are telling me we are going to have a contraction.
Yeah. Well, borrowing power, in other words, how much people can borrow for a given level of income now is 40% lower than it was 18 months ago. right? That's because the banks are now obeying the responsible lending laws, whereas previously they weren't. And there's nothing in the Royal Commission recommendations that's going to change that. That's baked in, right? And APRA has been, in fact, they came out with a statement last week saying there are still significant risks in the mortgage and housing sector because households are so leveraged. So that APRA is concerned about the amount of risk in the system. We are not going to see loosening standards in terms of loans, certainly in the next 12 to 18 months. Therefore, there's a thing called the credit impulse, which is the rate of change of credit growth, right? Which is my fundamental lever and measure that I look at in terms of predicting home price movements. As the credit impulse eases, and it continues to ease now, in other words, the rate of growth drops, that's what translates to home price falls. And until the credit impulse goes up, in other words, the rate of change increases again, home prices will continue to slide. There's no evidence at all that the home prices will do anything other than to keep falling. That negative wealth effect, therefore, will continue to flow through. Households will continue to hunker down. Less people will buy into the market. As you say, overseas buyers have pretty much voted with their feet. Many of those bought these off-the-plan apartments that suddenly look as though they could be poorly constructed, like Opal Tower. That's another factor to bear in mind as well. The Chinese have also screwed down international money transfers, so it's harder for people to bring money down here as well. Put all that together, and I can give you a whole bunch of reasons why home prices and economic activity is going to continue sort of to go south. I can't see any reason why it would reverse. The Royal Commission does not change this one iota.
Yeah. Well, guys, I want to thank you all so much for tuning in. Hopefully that's been a good rundown of the main points and highlights from the Banking Royal Commission. But any final thoughts, Martin? Is this going to change anything? I guess that's the question that everyone's asking after all the commotion that's been in the media for years now.
So, I think there's two things to say. The first is, I think that the lasting contribution to the Royal Commission will not be this final report, but it will be those 65 days of hearings and all the case studies that actually laid bare the really bad behaviour across the financial sector, right? Those should be seared into our minds, because that is actually the experience of so many people at the moment. And if we forget that, then the whole thing was for naught, right? That's the first point. The second point is, because of the way that the Royal Commission has been presented in its final report, and the fact that it's pulled back from so many of the potential it should have dealt with, I don't now regard this as a strategic change that we needed. And I expect to see the diary card come out in about 5 years' time, as we did 5 years ago, to have another commission into the financial services sector, because we haven't yet learnt the lessons that we need a different way to think about banking and finance if Australia Inc. is going to actually thrive, not just survive. And so my concern is that effectively we haven't solved anything. Diary card 5 years down the track, we'll be doing it all again.
And that's the diary card for the US. Are they about to do it all again 10 years after a GFC? And have even they learned their lesson? So what an interesting time to be alive.
No, they haven't. I'm afraid that we're going through it all again. So, the cyclical thing about credit being allowed to blow things up and just lift asset prices, cut interest rates, that's the fundamental problem. And whilst we are continually fixated with that model, then we're going to see this continued cycle of, boom and bust and boom and bust and ever low rates. We need a different path, but that path is fundamentally not debt-driven. It's fundamentally not credit-driven, and that's going to be a whole new ballgame.
And we'll continue to talk about it for you guys. So make sure you're following Martin on Walk the World YouTube and Digital Finance Analytics. Thanks so much for tuning in, guys. We will talk to you again soon, and we'll end it there.